Welcome back to Stock Market Insights. Today, we're diving deeply into an essential skill every investor must master: fundamental analysis. Clearly understanding this method will help you analyze and interpret financial statements effectively, leading to smarter and more confident investing decisions. Let's explore this step by step. Fundamental analysis is an investment approach used to determine a company's real or intrinsic value by meticulously reviewing its financial health, economic environment, and market position. Unlike technical analysis, which relies heavily on price charts and historical data, fundamental analysis involves an in-depth look into the company's financial condition, including profits, debts, revenues, and growth potential. Investors using fundamental analysis often pursue long-term investment strategies, seeking solid financial performance and growth rather than short-term gains driven by market sentiment. There are three essential financial statements every investor should clearly understand. First, the balance sheet. The balance sheet details a company's financial position at a given point in time, clearly showing assets, which are items of value owned, liabilities, meaning debts owed, and shareholder equity, or net worth. The fundamental formula here is assets equals liabilities plus equity. Investors use the balance sheet to assess if a company is financially stable and well-positioned to fund future growth. Next, the income statement. The income statement clearly presents the company's revenues, costs, and overall profits or losses over a set period, usually quarterly or yearly. It allows investors to see how efficiently the company generates revenue and controls its expenses. Finally, the cash flow statement. It tracks actual cash flowing into and out of the company, categorized by operating, investing, and financing activities. A positive cash flow is crucial for sustainability, indicating the company generates enough cash to cover operations, expand business, repay debts, and reward investors. Now let's clearly define and explore important financial metrics. Earnings per share, or EPS, calculates how much profit a company earns for every share outstanding. For example, if a company has a net profit of $20 million and 4 million shares outstanding, the EPS equals $5 per share. Higher EPS is usually indicative of robust profitability and investor appeal. Debt-to-equity ratio. This ratio measures the financial leverage of a company by comparing total liabilities to shareholders' equity. A ratio of 1 means equal debt and equity, while a ratio above 2 indicates a higher risk due to increased leverage. Current ratio. This metric evaluates the company's short-term liquidity by dividing current assets by current liabilities. A current ratio of 2 implies the company has twice the assets to cover immediate debts, which is considered financially healthy. Return on assets, or ROA, measures the effectiveness with which a company uses its assets to produce profit. For instance, if a company achieves $6 million profit using $60 million in assets, its ROA is 10%. A higher ROA signals efficient asset management. Let's clearly demonstrate fundamental analysis using Apple as an illustrative example. Balance sheet. Apple has extensive assets including cash reserves, inventory, and property. Liabilities are primarily debts and accounts payable, balanced by equity representing shareholder investments. Income statement. Apple's income statement clearly highlights revenue streams from product lines like iPhones and services, minus expenses such as manufacturing, administration, and marketing to show net profit. The cash flow statement is crucial. It clearly shows cash generated from business operations, how much cash is reinvested into product development, and cash returned to shareholders through dividends and share buybacks. Key metrics clearly indicate several important aspects. Strong earnings per share reflect high profitability. A balanced debt-to-equity ratio demonstrates manageable debt. A healthy current ratio illustrates strong short-term liquidity. And finally, an impressive return on assets shows efficient asset utilization. Clearly understanding the pros and cons is crucial. So, let's talk about the strengths of fundamental analysis. First off, it provides a long-term view of investment value. This is crucial for those looking to build a solid portfolio over time. Secondly, it helps identify undervalued stocks early, giving you the chance to invest before the broader market catches on. And finally, it encourages rational, informed decision-making by focusing on financial facts. This way, you're not just going on a hunch or a whim, you're making decisions based on solid data. Now on the flip side, there are some weaknesses to consider. For one, it requires extensive analysis, research, and time. This can be a bit overwhelming, especially for new investors. Another point is that fundamental analysis does not account for short-term market fluctuations driven by sentiment. So, you might miss out on some quick gains. And lastly, it depends on accurate, transparent corporate financial disclosures. If the information is misleading or incomplete, your analysis could be way off. Mastering fundamental analysis equips you with a powerful tool to understand the true financial health and investment potential of companies. While it requires dedication, clearly grasping this analytical approach positions you significantly ahead in making sound, confident investment decisions. If you found value in this video, please like, subscribe, and share. Your engagement supports our continued effort to provide insightful and educational content. Stay tuned for our next video, where we will clearly illustrate combining fundamental and technical analysis for maximum investment effectiveness. This video is for educational and informational purposes only, and should not be considered financial advice. Trading and investing involve significant risks, including potential loss of principal. Always consult a qualified financial advisor before making investment decisions.